Today, I'm going to show you how you can save up to $67,000 into your Roth IRA each and every single year. And then I'm going to show you why you don't want to do it that way. And I'm going to show you a better saving strategy so you can save and reduce your taxes today and your taxes tomorrow and have a ridiculous amount of tax-free income in retirement. What's going on, guys? Welcome back to the channel. If this is your first time at our channel, welcome to the channel. My name is Travis Sickle. And this is a type of saving strategy that I talk about a lot on this channel, but I want to walk you through some of the thought processes of why I use this. And I really think that only saving into the Roth IRA is really not the right way to go. And I'm going to show you. And of course, if you disagree with me, let me know in the comments down below and let me know why. So let's go ahead and bring up my whiteboard so I can show you the saving strategy. Now, nothing about this is rocket science. However, you need to make sure that you're paying attention to some of these details so you don't make massive errors in your planning. So the first thing you can see up here is I have all the different types of retirement plans that you likely have access to. So we have a workplace plan up here. I put it up as a 401k. If you're an independent contractor or self-employed, it could be a solo 401k. If you have a workplace plan, a 401k, or a 403b. Any of those types of plans will work for this scenario. And of course, we have our traditional IRA and our Roth IRA. And this is where we're gonna get most of the focus on today to get that $67,000 into this plan. Now, if you're under the age of 50, you probably already know this, but you can save up to $6,000 into your IRAs, okay? Your traditional or your Roth, and that's a combined amount. So if you wanted to put $3,000 in your traditional, you could put the remaining $3,000 in your Roth IRA, for example, right? So in this example, I'm gonna assume that we're high income earners because we're saving a lot of money. So we're gonna have to use a different strategy. That is the backdoor Roth conversion. So we're gonna put that $6,000 right into our traditional as a non-deductible contribution, and then we can convert it over to the Roth IRA. That's how we can get it in here. If you're below the income thresholds, you can make the contribution directly to your Roth IRA, but likely you're gonna have to use this strategy in order to convert it over. Now, you have to be careful here because of the pro rata rule, but if you're not familiar with what that is, it's taking an equal ratio of your non-deductible contributions. Those are your after-tax contributions that we did the mega backdoor strategy with. And you have to take an equal amount to that pre-tax money that might already be in your traditional IRA. So if you have an old 401k that you rolled into your traditional IRA, that would likely be your pre-tax dollars. So you have to take an equal ratio. What this means is you can't cherry pick the non-deductible contributions, and in order to convert it, that means you need to convert the entire account. But there's a way around that, and you can simply take this money and roll all that pre-tax money into your current 401k or 403b, whatever retirement plan that you have. But again, one of these things that you need to watch out for in doing this, you can't just assume that you can do it. You have to look at your plan documents of whether or not your retirement plan at work will accept the money. That is where you want to look. It doesn't matter about your IRA. Your IRA can roll into this account, but the workplace plan is the one that has to accept the money. So that's what you need to look into. Now, if that's the case, you get all the pre-tax money out of your traditional IRA into your plan, and then you can do the non-deductible conversion and you're out of the clear. So they're not gonna have any additional taxes. And that's what you're really trying to avoid. Now, this isn't always the worst case scenario. If you have to deal with the pro rata rule and you can't roll it into the 401k, you just have to do a little bit of math to kind of figure out how much more in taxes are you gonna pay. Again, it's not the worst thing in the world if you have to pay some more taxes in order to convert. It really matters on this balance. If you have, say, $100,000 and you're making a non-deductible contribution of $6,000, then yeah, it might make sense to figure out how to get the money out of this account. But if you only have a couple of $1,000s, maybe we just get it out of there, convert it over, and then you won't have to deal with it. And then you're just focusing in on your retirement plan at work. So that is what I would take a look at. Now, how do we get to the $67,000? That's where our workplace plans are gonna come in. So for 2022, the most that you can put in to your workplace plan is $61,000 if you're under the age of 50. Now, most people get tripped up on this because they know that they have their traditional side and their Roth side, and they think that it's a $20,000, I'm gonna write it up here, a $20,500 contribution limit. That is the employee deferral. So your employee deferral will be either pre-tax directly into the traditional side of your 401k, or you can split it up any way that you want, or $20,500 into the Roth 401k. So that is only the employee deferral. Above and beyond that, we can do the non-elective contributions. So this will be a non-deductible contribution into your 401k. In doing that, we can put in an extra $40,500. So you can make a non-deductible contribution, the same type of contribution that's down here with the $6,000, but you can do it for $40,500. And then there's no pro rata rule in your workplace plan as long as it's not an IRA. So if it's a SEP IRA or a simple IRA, you still have the pro rata rule. Otherwise, you don't have it. So you can cherry pick. So we could say, you know what, I'm gonna make this non-deductible contribution and I'm gonna leave this $20,500 on the traditional side, and I wanna take just this $40,500 and put it to the Roth 401k. You can do that. So that is called the mega backdoor Roth conversion. You can do that. And then we can take this $20,500 and either make the direct contribution to your Roth 401k, or you can just convert it. Same tax consequences, but here's what I would point out. The year that you do the conversion, if it's pre-tax dollars over here and you're doing this conversion, it is taxed in the year of conversion. Now you can do these non-deductible contributions, especially if you're self-employed. You can do them after 12/31, make that non-deductible contribution and then get it over. But because it's already pre-taxed, that will count for the year of the taxable year that you're making the contribution. So even if you're in 2023, you can still make it count for 2022. But that $20,500, if it's in the traditional side and now we're in 2023 and then we do the conversion, that is going to be taxed in the year of conversion. So it'd be taxed in 2023 if you waited until 2023. Of course, if you did it in 2022, that would be the year that would be taxable. Again, if we put it directly into the Roth side, then you're in the clear because it's an after-tax contribution directly to the Roth 401k. Now, most people, at least in my opinion, there's no scientific evidence on this stuff. In my opinion, with saving $67,000, it's likely that you're going to be able to retire early. If you're saving this amount of money each and every single year, it's going to accumulate really fast, and you're going to have quite a nest egg. So there's a good chance you're going to want to retire early. Now, even if you don't, there is a good chance that you want to control your taxes. Now, unless you think you're going to work up until age 70, then you want to do it a different way. And here's why. The reason that I like to keep money on the traditional side, and by the way, I told you I do this strategy. I put my $20,500 into the traditional 401k, and I'm going to leave it there because I know I can get all that other money to the Roth side. So the reason I'm doing this is to lower my adjusted gross income so I can qualify for more credits, more deductions. So there's tons of credits and deductions out there that you can qualify for, whether it's your taxable income or your adjusted gross income or a modified adjusted gross income, all these different thresholds they put out there. We can lower that amount by putting it in pre-tax. That's going to help you today. Now, a lot of people say, well, aren't I going to be in a higher tax bracket down the road? You know, if I'm just starting out, it's unlikely for a period of time that each and every single year that you're always going to be in a higher tax bracket. But what we do know today is there's a lot of credits and deductions that you probably won't qualify for down the road, like the child tax credit. If you have kids, it's a use it or lose it. So if you're making over those amounts, and for 2022, that's $200,000 for singles or $400,000 for married filing jointly. If you're over these thresholds by a little bit and you can get your income below it, you're going to be putting more money back in your pocket and reducing the amount of your taxes. And especially if you're in those higher tax brackets today, you're going to bump it down. So that's quite a bit of savings. And these things keep popping up. You know, we have this Inflation Reduction Act that also has qualifications. Again, they're at all different income levels. So you really want to pay attention to that if you're just focused on the Roth side. That's why I don't like the Roth side 100%, because these dollars over here are going to help us reduce our taxes today. These ones are going to help us reduce our taxes tomorrow. But something that you might not be aware of as you're growing your income, if you're not going to work until age 70, then it's likely that you're going to need to start drawing on an income. Well, again, you don't have maybe a mortgage payment anymore. You don't have write-offs anywhere else. And it's likely that you're not going to be working, right? You're retiring early. So you don't have those business expenses. You're not doing a whole lot. There's a good chance, even if you actually spend more than you are right now on in your personal life, those expenses are not going to be there that you had in your working years. So at that point, you're only having your Roth IRA. So that's 100% tax-free. There's no other taxable income. So your Social Security, you want to delay that until age 70 because that's going to get you the biggest bang for your buck. Going from age 67, so if you're born after 1960, age 67 is what we call our full retirement age. Now, full retirement age actually means nothing to you. It's just a number. 67 is just full retirement age. They shouldn't call it full retirement age. They should come up with another name for it because most people think, oh, full retirement age, that means I have to take it at that age? No, you could take it any time from age 62 to age 70, but the longer you delay it, the more that you're going to get. And it's 8% after age 67. So if you're born after 1960, then your full retirement age will be age 67. At 68, you would get 8% more than you'll get on a monthly basis for the rest of your life than you would have if you took it at age 67. Wait until age 69, you're going to get another 8%. Wait until age 70, you're going to get another 8%. That's 24%. So if you delay it 3 years, 8%, 8%, 8%, that's 24 years. So you're getting 124% of what you would have gotten at age 67. And I know what you're thinking. Probably already put the comment down there. I'm not going to have Social Security. It's not going to be what it is today. And it might change, but there's a highly unlikely that they'll get rid of it. Because if you think about society, you need to have those nets, those catches for people who aren't saving. And Social Security is one of those programs that if you get to that point, that's how it was originally designed. It was designed for those that lived older, past what they actually thought you were going to live to begin with. But they wanted to have it as a safety net for people who didn't save. And it was saying, okay, we're going to live for a couple more years. Now it's expanded to, okay, now we're using this amount of money for 20, 30, 40 years into our retirement. So that is a much greater amount that you're going to withdraw on it. So to think that it's not going to be here, it's not. It's going to be here. It might be a little bit modified. But in any case, there's a high likelihood that you'll delay it, so you're going to get the maximum amount. And if you're married filing jointly, it's even more of a benefit to delay it in a lot of instances because if something happens to you, then your spouse will get more, likely. Depends on the math. So that is something that you want to take a look at. And in delaying all this, that means you have this long gap, especially if you retire early, that you're not going to have much taxable income. Therefore, if you have traditional IRA money, yes, that's going to come out as ordinary income. But as you can see, that makes total sense because you have no other sources of income likely that you're going to want to say, hey, it should all be in the Roth IRA. It should all be in that tax-free account. So that is why I like to balance it out. And if you're uncertain, if you don't have a crystal ball, you don't know where taxes are going to be in the future, having both gives you that flexibility. If the administration decides to raise taxes, you pull more money out of your Roth IRAs. If it lowers taxes, then you can pull more money out of your traditional IRAs. You can kind of play this tax game, the same tax game that I'm telling you to play today. And that is by putting more money in the traditional IRA. Oh, I can get that credit. I can get that deduction. Great. Put more money back in your pocket than just looking at the tax brackets. That's what most people do. They look at their tax bracket and assume, hey, I just need to get down to the lowest possible tax bracket today. And that's not entirely true. And you don't have to just forget about today and just only focus on the future. Balance it out, make your life a little bit easier. If you have any questions on this stuff, let me know in the comments down below. If you've enjoyed this video, be sure to subscribe and we'll see you on the next one.